Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and we're glad you're joining us today. We're starting off with a story that's got everyone in the financial community talking. Nifty, India's premier stock index, has just turned 29 years old, and what a journey it's been. From its humble beginnings to its current status as one of the world's top-performing indexes, Nifty has given investors a wild ride. According to Ashish Kumar Chauhan, MD and CEO of the National Stock Exchange of India, Nifty has grown 24 times in the last 29 years, from 1,000 points to 24,000 points. That's an impressive track record, especially when compared to other major indexes like the S&P 500. In fact, Chauhan notes that Nifty has outperformed the S&P 500 in dollar terms, with a return of 11.9% on a CAGR basis. But what does this mean for investors? Well, it's a reminder that equity markets can be volatile, and there will always be ups and downs. However, for those who have stayed the course, Nifty has proven to be a rewarding investment. As Chauhan says, you have to stay longer to enjoy it. It's also worth noting that India's growth story is far from over. With its rapidly growing economy, favorable demographics, and embracing of technology, there's every reason to believe that Nifty will continue to perform well in the years to come. Of course, past performance is no guarantee of future results, and investors should always do their own research and consider their own risk tolerance before making any investment decision. But for now, it's clear that Nifty has been a success story, and its 29th birthday is definitely worth celebrating. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show, and we've got a fascinating story to share with you. Today, we're diving into the world of finance and politics, where the lines are often blurred. Our focus is on the recent developments surrounding the U.S. Federal Reserve, its chairman Jerome Powell, and the ongoing trade tensions. As you may know, President Donald Trump has been vocal about his dissatisfaction with the Fed's monetary policy decisions, particularly when it comes to interest rates. He's been calling for lower rates to boost economic growth, while Powell has maintained that the current stance is appropriate given the economic conditions. This public feud has sparked concerns among investors and economists alike, with some warning about the potential consequences of politicizing the central bank. Now, let's take a closer look at what's been happening. Trump has taken to social media to criticize Powell, even going so far as to nickname him too late and a major loser. These comments have led to a decline in the dollar's value against other currencies and a surge in gold prices, which have now exceeded $3,500 an ounce for the first time. The Dow Jones Industrial Average and other major stock indexes have also experienced significant fluctuations. It's essential to note that the Fed's independence is crucial in maintaining the stability of the financial system. As the central bank, it's responsible for setting monetary policy, regulating banks, and ensuring the overall health of the economy. Any perceived interference or pressure from the administration could undermine this independence and have far-reaching consequences. The International Monetary Fund has weighed in on the situation, warning that Trump's tariffs have unleashed a major negative shock into the world economy. The IMF has cut its forecast for us, UK, and global growth, citing the ongoing trade tensions as a significant factor. As we navigate this complex landscape, it's crucial to consider multiple perspectives and potential outcomes. While some argue that lower interest rates could provide a much-needed boost to economic growth, others warn about the risks of inflation and the potential consequences of meddling with the Fed's independence. We'll continue to monitor this situation closely and provide updates as more information becomes available. In the meantime, we encourage our listeners to stay informed and consider the potential implications for their investments and financial decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's episode with a closer look at the ongoing trade tensions between the US and China. As we've been following the developments, it seems like there might be a glimmer of hope for a more diplomatic approach from the Trump administration. According to recent reports, President Trump has stated that he has no intention of firing Federal Reserve Chairman Jerome Powell, despite his previous criticisms. This comes as a relief to many investors who were worried about the potential consequences of such a move on the U.S. economy. Additionally, Trump expressed optimism about improving trade relations with China, saying he would be very nice in negotiations and that tariffs would fall if a deal is reached. However, he also clarified that tariffs wouldn't drop to zero. This nuanced approach might indicate a willingness to find common ground and ease the trade tensions that have been affecting global markets. U.S. Treasury Secretary Scott Bessent also weighed in, saying that the current situation is unsustainable and expecting a de-escalation of the trade war with China. These statements have contributed to a slight uptick in Asian stock markets, with investors seeming to welcome the possibility of a more constructive dialogue between the two nations. It's essential to note that the trade tensions are far from over and the situation remains volatile. The International Monetary Fund has downgraded its forecast for U.S. economic growth due to the uncertainty caused by tariffs, and the global economy is still feeling the effects of these trade disputes. As we close out today's episode, it's crucial to remember that investing in today's market requires a careful and informed approach. While there might be signs of optimism on the horizon, it's essential to stay vigilant and adapt to the ever-changing landscape. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.